Hi, everyone. Money Show is pleased to welcome back Rob Anderson, the president of BV Capital, which is a real estate private equity firm based in Dallas, Texas. Today, he is here to discuss how Texas is booming and it is just getting started, which makes Texas a great place to invest in real estate. Rob, we look forward to your insights. Please feel free to take it away.
Thank you, Rena. I appreciate that. Hello, everybody. I'm going to speak a little fast. I've got a lot of information for you. I'm going to try to present in a small amount of time. And for any questions, I want to make sure we get to those. I'm also going to take my picture off here in a few slides just so we can focus on the presentation. At the end, I will come back. So first off, I'm going to talk about the current environment that we're in. I'm going to talk about briefly why to invest in real estate, but mostly what I'm going to talk about is the Texas real estate and the Texas economy. And then most fun probably for you guys is I've got 4 case studies that I'm going to do at the very end of this that'll go into specific deals we're doing, new deals we have coming out, the dollars and what it meant to our investors and what it returned to our investors. For example, were we truly able to double their money in 3 to 5 years, like we say, because that is really our goal for our investors. And we have done that most of the time, not always, of course, because nothing's guaranteed, but a lot of times we are able to accomplish that. So let's go ahead and get into that and share it with you here. First off, we are a broker dealer as well, so we've got to meet a higher standard. We're audited by FINRA. So let me first read this real quick to you. This is not an offer to sell or security. That must be done through a private placement memorandum. You must fully read the risk factors, and we'll be absolutely happy to walk anybody through it on any deal that we would do going forward. This is materials designed to be educational. All right, so let's get started. For generations, let me go ahead and stop my video here. For generations, direct real estate investing has provided immense wealth, but only for the select few. And if you're not aware, there was a law change in 2012, and the SEC cleared that up in 2013 that allowed people like yourself and myself to have access to these private deals going forward. So let's talk about the current environment. The current environment is unique, as many of you know. What we're facing today is we have markets that are too heavily correlated. It is hard to diversify nowadays. You know, I got securities license back in the 90s, and it was quite easy to diversify. You had large cap, you had small cap, you had mid cap, you had value growth. You might have an index, and ETFs came on the scene. You might have the fixed income markets, et cetera. Unfortunately, what we saw in '08 and '09 is just about everything went down, and just about everything went down the same amount. We saw that even more so last March, in the March of 2020, when the market sold off heavily last year during COVID. And sadly, there was no place to hide. And in order to truly have diversification, you've got to have some private market exposure. The next thing we're dealing with is inflation. And I don't want to get into, there's a lot of argument about inflation. Is it here? Is it not here? Is it momentary? Is it long term? It doesn't matter if it's momentary or long term. Inflation is here. Just go out and look at the bill at your restaurant if you go out to eat. Look at your grocery store. Look at gas. I was in Colorado last week, and I had $4 gas. I feel for my friends out there. I live in Texas, and we're around 250. So there is inflation. There's inflation around, and we need to take that in mind as we look at our investing portfolios. Lastly, taxes. Taxes will be changing. Right or wrong, it's a fact, and we need to look at it, and we need to understand how to incorporate taxes in our investing portfolio. And that's what we like to do when we look at deals ourselves. So for time, I'm going to speed ahead. So I'm not going to spend a ton of time on this, but I do want to mention this for those of you who may not be as familiar with real estate. Why do people invest in real estate? It's right here in front of you. Diversification. This is an uncorrelated asset. It provides cash flow. It's got much lower volatility than the stock market. It is asset backed. There's a large, expensive, physical, tangible asset backing the value. It's an inflation hedge. The things that drive inflation also drive rents. They drive the amount of leases, and they also they grow the value of real estate. And lastly, there's really good tax advantages here as well. And if you guys want to get into further detail on any of those, we'll be happy to have a conversation with you online. We don't have a ton of time for the purposes of this presentation. So let's move into why invest in Texas real estate. And you're going to be surprised at this. I was actually surprised in doing some of the research, but Texas, as we all know, is exploding. Look at those number ones. We are number one in job growth. We're number one in corporate relocation. We're number one in population growth. We're number one in GDP growth. We're number one in exports. One thing I didn't mention is manufacturing growth, and we have no state income tax. And Texas is exploding. Why does this matter? Is if you invest in real estate, it's location, 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 right? And the two things that we look for the most are job growth, and we look for population growth. And obviously the economy is a big factor there. So let me show you where some of this comes from. Texas was the #1 job creator 9 years in a row. Now, the stat I have up here is from the Bureau of Labor Statistics in 2020. However, Texas has received the Governor's Cup from the Site Selection magazine for 9 years in a row. And what they did is they awarded Texas as the top job creator. This is not a new phenomenon for us in Texas. It's happened 9 years in a row. And corporate relocations, as you can see as well, the #1 destination for company relocations based on the Dallas Fed report here. The corporate relocations is probably one of the things that's been the most newsworthy that people around the country have seen. The likes of Elon Musk moving Tesla to Austin and having that giant gigafactory that he's created. Hewlett Packard's moving to Texas. Oracle is moving to Texas. CBRE is moving to Texas. Even the PGA is building a giant facility, and they're moving to Texas. Further than that, we've had expansions. And just so you guys know, we've already had 50 of the Fortune 500 companies headquartered here to start with, prior to all this expansion. But further expansions, Amazon is growing a massive operation here in North Texas. It's rumored to be a potential equivalent to their Virginia operation. We will see. Charles Schwab has a giant, has grown their location. Fidelity has grown. SpaceX, no surprise with Elon Musk being here. Apple's second largest operation is getting built in Austin right now. Goldman Sachs is going to build their second largest location outside of Manhattan up here in North Texas in Dallas. So there is a ton of relocations happening, and what that just brings people and that brings jobs. Furthermore, as I said, people, the #1 growing population right now. It's amazing what has happened here. We have 14 million people in the labor force, second highest to California. So it's also a nice pull for companies as well. Now, here's the big thing for investors to look at is #1 for GDP growth. Texas is now the 9th largest economy in the world by GDP. That's ahead of Canada. That's ahead of South Korea. That's ahead of Brazil. So it's a very fascinating marketplace and what's happened. So GDP growth is a big one. We always want to talk about that. On job growth, I forgot to mention this. In 2019, Texas added 342,000 jobs just in 19. And what's interesting is, I go back to the corporate relocation story. The corporate relocation pipeline is actually bigger post-COVID than it was pre-COVID. So it's interesting what's happened here. To go ahead and move along, though, #1 exporter in the United States. And I know we've got the oil and gas picture there. And it's not just because we're the energy headquarters of the world, but we also export a ton of manufacturing. And I'm going to talk about that later. But Texas has 27 airports and 16 seaports with over 600 miles of coastline. So it creates a really good place for manufacturing and a really good way to export. We've actually been the #1 U.S. exporter for 18 years in a row. A lot of people don't realize that. The Port of Houston is one of the largest ports in the world. So lastly, and I know this is no news to anybody on this call, but no state income tax is a big lure, and I can tell you we love it here. I've had a friend that just got moved back. He had a promotion out of state, and it was a giant promotion, but because of the tax difference, he really didn't see the change. And that's a little disheartening for my friends around the country. But having a no income state tax is a big deal for us. So that's a little bit about what's going on there. Now, what do we do, right? Well, where do we take this? And if you look at what's happened over the last couple of years, COVID-19 is a real deal. Obviously, we all know that. It's changed the landscape. It's changed the real estate landscape today. And we have to look for pandemic-resistant investments. I put 3 down here below in multifamily, and I'm going to show you 2 types of multifamily. We've got industrial, and we've got single-family lot development. And I'm going to talk about those in a little bit more detail as we go through. Multifamily is an incredibly resilient property type, high demand from institutional buyers. Pays quarterly income. It's usually got a pretty nice pop at the end when we sell that due to the leverage on the property. Industrial is the blue chip in today's real estate market. If you think of blue chips in the stock market, you think of the largest companies out. You think of growth and income. You think of large value. I want you to think of industrial the same way when you look at real estate. It's a very high demand from institutional buyers. In fact, institutions almost exclusively own the category. It's really tough to find an industrial property on the retail side. We've done a decent job of doing that. We actually have a fund that's open for you if you like that asset class. I'll talk a little bit about that later. The neat thing about it is it does provide stable monthly income, and it's a good bond alternative potentially depending on your situation. Lastly, single family lot development. This is a newer one for us because the suburbs are exploding with people not wanting to be as dense as they were in the past. A lot of folks are moving to suburbs. In fact, our multifamily is predominantly in the suburbs as well. We don't do very much high density like we used to. One of the effects of COVID, which is pretty commonly known, is the central business districts and the high dense areas are hurting. That's another thing about Texas I want to point out. We have a lot of land. We've got more land than we ever need here, and it's easy to spread out. And so for folks who want to not be on top of each other, Texas is a good option for you. The single family lot development deals are we're basically doing the infrastructure for neighborhoods, and I'll talk about that here in a little bit later. It does provide quarterly income. It's got a pretty decent pop as it's sold. The neat thing about it is it's kind of sold in tranches. Whoops, sorry about that. It's sold in tranches as opposed to waiting till the very end. So that's a neat one as well. So let's go ahead and get into the actual properties and the case studies that we have for you here, okay? First off is multifamily. The Grayson is a 330 unit ground up construction project we did down in Houston, Texas. We own our own construction company. We have our own general contractor, and we're actually HUD approved. And I know a lot of people, when they think HUD, they think low income. But HUD actually is one of the best lenders for multifamily, regardless of the asset class. So as you can see, this is a Class A property. This is a nice property. And by the way, all of these pictures are pictures of properties or projects that we have done. Moving forward, as I said, the neat thing about multifamily is it's got the most preferential lending. I'll give you an example. So I was talking about HUD a second ago. We're building a ground up construction project in Garland, Texas, which is a close-in suburb of Dallas. And it's about a 300 unit property. It's I'm forgetting the size of the loan. I want to say it's about 25 million. But here's the statistics on it, which is fascinating. We have a 35-year amortization schedule at 3.1% interest rate and 2 years of interest only during the construction phase. It is an unbelievable financing opportunity is what HUD gives us in multifamily. It's the best on the market. The banks can't even touch it. So when they find out we're going through HUD, they quit calling us. It's fascinating. So benefits of multifamily, you get great financing. Another benefit is there's high demand. Millennials up until just now, we're almost exclusively renters. Now we are starting to see a lot of family creation and a lot of them moving out to the suburbs and buying homes. And then you got Gen Z right behind them, and they are almost exclusively renters as well. The interesting thing, though, is the baby boomers are now selling their homes and opting to rent over owning a home. We're seeing that more and more so now. But here's one thing I want to point out. When you invest in multifamily, you have a diversification of income. As if you're, for example, if you invest in a 300 unit multifamily property, you could have upwards of 300 different employers paying the salaries of the tenants in your property. That is great diversification. So let's say there's something happens to one or two of those companies. We still got 298 or 299 that are just fine is the idea. And so you've got great, it's a stabilized a way to get your rent each month because you're not just depending on one employer. So we like to point that out. Now, let me show you some stuff here on Texas. Texas is dominating the construction market. So if you look at my chart on the left, Houston's number 2, Dallas is number 3, Austin's number 5, and San Antonio is number 14. That is for construction in the first quarter of 2021 for multifamily units. And I can tell you guys, we're still behind the curve. We still do not have enough units coming on the market to meet the demand of the amount of people moving here. Isn't that crazy? But that's true. That is exactly what's happening. Now, my notes on the right side of the screen are a little different. This has to do with invested money, like what assets were bought or built. And out of the $35 billion that was invested in multifamily across the United States, the 4 Texas metros combined for 5.8 of that. That's 17% of all investment around the country happened here in Texas in the first quarter of 2021. We think that's actually going to grow. And in fact, Dallas-Fort Worth led all metros in the entire country with $2.8 billion in total investment. Dallas is exploding, guys. I don't know if many of you know this, but we have one of the most diversified economies in the country. It is very close to the breakdown of the S&P 500, and it is a very central location with a giant airport, so it makes it easy to do business here. And we have a ton of folks moving here, which is pushing this this volume that you're seeing. Now let's get into the actual deal here. I showed you the Grayson earlier. This is the pool that we built. I love this pool. It's one of my favorite pools we built. We got a $30.5 million loan. We got $6 million we raised from investors like you and I. I say you and I because I invested in this deal myself. We invest personally in all of our deals. We started this in March of 2015. The total project was $36.5 million. It was 330 units we built from the ground up. Project finished and sold in April of 2019 for $48.8 million to a California investor. Profit of over $12 million on a $6 million investment is how we got a double for our investors in 49 months. I'm sure many of you guys would love to average a double on your money every 4 years, and that is exactly what we're trying to accomplish for our investors. Now, it doesn't always happen. Our longest deal was 6.5 years. Our shortest deal was 2.5 years. It just depends on the deal. It depends on what's going on. But this is a good kind of baseline case that we like to show. We have better ones, but I don't want to show you my best one. I want to show you a baseline case to show you how we work with folks. Now let's move on. This is a different type of multifamily that I want to show you. This is student housing. And student housing around the country has had a lot of problems, but once again, down here in Texas, it's been a much different story. We're in the process of acquiring 2 student housing properties, one at TCU in Fort Worth and one at the University of Texas at Arlington up here in the DFW area. And what's interesting about student housing, all these units are guaranteed by parents or the university. Much better credit than a typical multifamily tenant. Values have risen across the country for 7 consecutive years. We also have the lowest delivery of new units since 2013, meaning the amount of supply coming on is the lowest that we've seen in 8 years. The thing that we like the most is over 2/3 of buyers in this particular property type are institutions. When institutions buy a property type, that helps you secure your exit. I see a lot of deals out there, and the first thing I ask them is how certain are you of being able to get out of this or sell this someday? And if they don't have a good answer, I'm really iffy on that deal. The exit to me is one of the most important aspects of a real estate investment. And that's one thing that we love about student housing is the institutions, whether they be REITs or pension plans or foreign investors, love this category. Now, let me move on here. I mentioned Texas earlier when it comes to this. Look at this chart. This chart is fascinating. This is from 2008 to 2018. It's the most current we were able to get. This is from our friends at the College Board Research Group. And Texas had 23% enrollment growth in that 10-year period. Number 1 in the country. The average in the United States was 4%. So we're almost 5 times as much. Actually, we're more than 5 times as much. So almost 6 times if you really do the math. So Texas higher education has done exceedingly well. We've grown more than any other state in the U.S. Now, the effects of Texas opening early after the pandemic is added incredible fuel to this. We have more out-of-state transfers coming to Texas universities than we've ever had. And what's happening is these schools do not have enough, they're not able to house them. They have more students than they have housing. And so what's happening is properties like ours are providing the overflow for a lot of these universities. In fact, we just signed a lease with one of those universities that I mentioned to become the overflow for them. In fact, this picture is our TCU property that you see to the right. Now, let me show you the details on this one. We're getting a $21.4 million loan, which is only 71% leverage. That's really healthy leverage. It's not high in this asset class. We raised $8.6 million in equity from ourselves and our investors. Once again, we invest in this too. I invest in this myself. The project cost $30 million. The properties are going to be renovated, and we're going to add certain services to grow the NOI. NOI is net operating income. If you're not aware, net operating income is the real estate equivalent to EBITDA. So if you want to look at what a multiple would be when you sell a property, you might have heard of cap rates, but EBITDA is what we look at when we look at the time for when we want to sell a property. The estimated return on this, we really feel pretty good that the estimated return will happen at a double for investors in a 3 to 5 year period. And we feel pretty good about that. Let's move on. Industrial. I mentioned this earlier. Industrial is the blue chip in the space. We have a fund that is available now. If you like this idea, please get in touch with us and we'll be happy to show it to you. We are buying industrial properties around Texas. These properties, like I said, they are the blue chip in the space. They are mostly triple net properties. Triple net, if you're not familiar, means that the tenant will pay the taxes, they pay the insurance, and they are in charge of all the maintenance and upkeep for those buildings. So the neat thing about this is the tenant is responsible for everything. All we have to do is enforce the lease and make sure the tenant's doing what they're supposed to do. Now, why industrial? Look at the boom in e-commerce and the need for warehousing, for distribution. There is a much heightened focus on U.S. manufacturing. There is definitely still a reconfiguration of global supply chains. There are a lot of things leading to needing this space. This space has prominently been eaten up by institutions because they're big and expensive, but we have the access to them. Look at this chart. This chart is fascinating to me. The gold is the United States total GDP and total manufacturing GDP. The green is Texas. So guys, I'm not making this up. This is amazing what's going on right now. Texas manufacturing is growing faster than the rest of the U.S. We employ almost 1 million Texans in this industry. It's 241 billion of our GDP, which is 13% of the state's total output. Texas is the United States leader in international exports of manufactured goods. We talked about it earlier with the #1 exporter. This leads to the need for industrial buildings. This leads to the need for building more, developing more, and this gives us a lot of good investment opportunity. So what does it mean? It's a buy and hold strategy. What we're doing is we're passing along the lease payments on to our investors. We typically get leases that are anywhere from 10 to 20 years, sometimes longer. Investors will generally get around 7% annualized. They get monthly income that adds up to that, and a lot of people like the monthly income. There is upside at the end. And the reason is the institutions love to buy portfolios. Once again, we're all about the exit when we do a deal. Institutions do not like to buy these one at a time. They like to buy a portfolio. We're happy to buy them one at a time. We will compile them together and then sell them to a big institution and get a premium on the exit. And that is a great scenario for investment. And we love to do that. And there's been a fair amount of activity or opportunity here locally to accomplish that. Next up, and lastly, this is my last case study for you, single family lot development. This is a growth investment. What we're doing is we're financing the infrastructure for suburban neighborhoods. So, I mean, if you look at this picture, before this neighborhood was developed, it was pure field. There was nothing there. So the infrastructure, as you can assume, would be the utilities, the water, the sewer, the electricity, the streets, the street lights, all of these things that are needed is what we do. And then we turn them over to a developer to then build the lots. So there's huge demand. Huge demand. There's very low inventory. Look at some of these statistics. The Texas housing inventory is currently at 1.2 months. That is an unbelievable stat. You know, a normal market is typically a housing supply of 6 months. 6. If it's over 6, it's a little unhealthy. If it's below 6, it doesn't have as much supply as it's needed. We are at 1.2. And the last stat is really interesting. We have 3-month moving average for days on the market in Texas when you sell your home is only 34 days. It's taking 34 days to sell homes here. I had a friend try to buy a home. It was a $500,000 home, nice home. It wasn't huge, wasn't crazy, but it was a nice home up in Frisco, which is a suburb north of Dallas. And the home came on the market. They went up there first weekend. They put an offer on. They were one of 96 people putting an offer on that house, and that house sold with under a week. Unfortunately, not to my friend, for $130,000 above asking price. Guys, I know our friends in California are used to this. We're not. This is unbelievable what we're seeing here. Let me give you some more. So if you look at this chart, I've talked about some of this. The month's inventory is 1.2 across the state. Housing sales is up. We all know where mortgages are. Days on the market. The home price index is up pretty high. We're not used to seeing that here in Texas. Now look at some of the months of inventory. Austin, Texas is the most critical market in the country right now, with months of inventory slipping to just 0.4 months. Unbelievable. Fort Worth is at 0.9 and Dallas is at 1 month. San Antonio 1.2, Houston at 1.4. And as you can see, there is a ton of need to build neighborhoods for all of the population all the population that's moving here. Let me briefly tell you how this is and we'll wrap it up and take some questions. Lot development. We're funding the infrastructure for suburban neighborhoods. The beauty here is we know the exit is what we do is we pre-sell the lots to a national home builder or multiple national home builders before we ever do the equity raise. The beauty of that is these home builders pay us 15% upfront for the entire neighborhood that they're planning to buy. Once we deliver lots, then we get the additional 85% of the sales price. This is typically a 3 to 4 year period. So unlike selling a portfolio of warehouses or multifamily property or something like that, where you get the pop at the end, here we kind of get the pop throughout, because as we deliver lots, we get the other 85%, which is a really neat opportunity. We've got several of these opportunities coming up. If this is of interest to you, please let us know, and we will put you in our database and let you know when these opportunities come out throughout the rest of this year, because these are neat when we're excited about this one. So let me just do a quick summary and we'll get into some Q&A for you folks. Number one, why do you invest in real estate? It's great diversification. It's uncorrelated. It provides cash flow, constant cash flow. It's lower volatility than what we've seen, in that it's asset backed, right? It has a physical, tangible asset there. And that's a private deal. You don't have the fear-induced panic selling that you sometimes see in the market. We also it's a great inflation hedge. We talked about that, and there are great tax advantages. And if you'd like to learn more about that, please reach out to us. Why Texas? Right, number one in job growth, number one in corporate relocations, number one in population growth, number one in GDP growth, number one in exports, and we have no state income tax. It is a great time to invest in Texas real estate, and we'd love to show you how we do it. So the question is, are you guys ready to add multi-million-dollar projects to your portfolio? We'd love to work with you. We are taking new investors, and we'd love to get to know what would be best for you. Here is the way that you can get in touch with us: our LinkedIn, our Facebook. Follow us, come to our website, please email us, reach out. I'm going to go ahead and put my video back on, and Rena, if there's any questions, I'm ready to answer them.
Awesome. Great presentation, by the way. That pool
Thank
was
you.
beautiful.
It was a good one.
Yep. All right. So first question, does joining as a partner result in a regular IRS K-1 report at year end? And are there alternatives to that form of reporting if not?
I'm going to give you two answers to that. Number one, yes. As an investor, you're a limited partner, because what you're doing is you're buying units in an LLC, and the LLC owns the underlying real estate. Okay. It's uber important to do it that way. Now, as a limited partner, you're only liable for the amount of money you invest, period. You're capped at that. The general partner, us, we have the other liability. So the question is, that does create a K-1 for you, which will give you a passive loss. Now, here's the thing, though. Some people don't like K-1s, but the K-1s give you the tax advantages. I briefly touched on that earlier. All the losses that we're able to take in real estate due to depreciation pass through to our limited partners, and you get to use that to offset your gain. You can't do that on 1099. You have to be a limited partner to get that benefit. And so the answer is yes, it is a K-1. And we would tell you that most of our investors appreciate that.
Awesome. Thanks. And then another one, can you actually provide additional details on the tax benefits?
I just did a little bit. Yes, I can. It's what we do is our distributions, we code as return of capital for tax purposes only. We do not lower your capital balance. We learned this from our friends at Trammell Crow, the largest developer in the country, is right here in Dallas. We use the same accounting firm they do, or their owners do rather. And what happens is, by coding the distributions as return of capital, you have zero tax consequences until the very end, because there's no current income to report. Now, what that does is that will lower your basis for when we do sell at the end. But the beauty, as I mentioned a second ago, is those passive losses turn to current losses when we distribute all the proceeds out of the LLC, offsetting that reduction in basis. What that allows you typically to do is you end up generally, now I'm going to generalize this because everything is specific, but a lot of times what we see is you don't pay tax on the entire gain. In fact, sometimes you only pay tax on half the gain, and the tax you do pay is only a long-term capital gain. I know that was a little in depth, and I can go further if somebody wants to visit offline, but that's kind of the 10,000-foot view of it for you.
Awesome. Thank you. Let's see. I believe this is information in your virtual booth, but maybe for the replay sake, what is the minimum investment?
It depends on what we're doing. Typically, our minimums are $50,000. You can use tax qualified money. You can use IRA money. We have a lot of self-directed IRA vehicles. In fact, our current industrial fund is available via Fidelity, Schwab, and TD Ameritrade, for example, as well as the Entrust Group, Millennium Trust, and plenty of the self-directed IRA vehicles that are out there. So I just want to make sure I mention that for everybody. But It depends on the deal, Rena, but typically it's around 50,000 is our minimum.
Got it. I'm not sure what this means. I hope you know what it means. What is GP and LP slip?
Sure. GP is general partner, LP is limited partner. The developer or sponsor is the general partner. We personally guarantee the loans, and frankly, our neck is on the line if something doesn't go right there. We can be sued personally and civilly. A limited partner is our investors. That's what you guys would be. So frankly, I'm on both sides of that myself. But as a limited partner, you're only liable for the amount of dollars you invest. You're not liable for anything over and above that.
Awesome.
I
Thanks.
believe that's the question that was asked. If
I think
not, please hit us up. I'll be happy to give you more color.
great. And then last question, as a Canadian with no connection to the USA, would I be able to invest?
Yes, you can. Yes, we have international investors. So to my Canadian friends, we'd love to have you down here. Now, the taxes are a little different in that there's a makeup in between the two, and there's nothing I can do about that. There's rules in between the United States and every country around the world as to how that works, but you can absolutely invest out of the country.
Great. And then I did get some more color on the GP-LP question. They wanted to know what the split was. Typo there.
Oh, they want to know the waterfall. That's different on every deal. That's different on every deal, so that's hard one to explain. I can tell you the last deal that we did on the student housing was the way it worked is now we think we do this a little differently. So number one, we had to give you an 8% preferred return. So we had to give you 8% on your money, number one. Number two, we had to give you 100% of your money back before we ever got to split any profits. So that's different. A lot of folks will split cash flow. We don't do that. We don't think that's right. So what we will do is we'll give you your 8% preferred return up front, number one, or 7 or whatever the deal is. And then we'll give you 100% of your money back. And then what we do is we'll split the profits after that. And that could be all over the board. It just depends on the deal, the risk parameters, how much risk we're taking on versus how much risk we're not taking on, et cetera. The student housing deal was a fairly normal deal. So I'll give that as an example. That was a 70-30 split, 70 to investors, 30 to us, up until we produce an 18% IRR. And then once we exceed an 18% IRR, it was a 50-50 split after that. The beauty of that is that incentivizes us to get the highest return possible for everybody involved. I believe that was the question, Rena. What I would tell you is if the split is too great in the favor of the investor, I would actually give you caution. How is that developer or sponsor aligned with your best interest if they're only making money along the way and not at the end? So that's just a philosophical difference that we have. We generally make less money during because we want to be incentivized to make that result at the end as profitable as we can, because that's really why you're investing.
Fantastic. Well, that puts us right at time. We did have some more questions pop in, but we do have to sign off. So I want to let everyone know that the virtual booth is probably the best place to reach out to Rob and his team, or any of these links on the screen: phone number, email, website, Facebook, LinkedIn. Reach out to them, ask more questions. And Rob, thank you so much for your time today and for chatting with our viewers and giving us an awesome presentation. We appreciate you.
Absolutely. Thank you.
For sure. You have a great day.